super basic what interest rate is, what term is, what amortization is in the mortgage world of things so that we can understand from our perspective. So Ryan, take it away.
So for the first part here, I'm just going to express very, very basic information. There's more that's going to come in another part to this video, but for right now, it's just going to be layman's terms what this all means. So an interest rate with a mortgage is essentially what you're going to be paying back to the bank for borrowing their money to be able to purchase a home. So if it was a fixed interest rate, and let's just say it was 3%, that's what your interest rate would be on your mortgage commitment. There's also a variable interest rate, which could fluctuate throughout your term, but we'll get into that later. The next piece, term, is how long you have your interest rate guaranteed for. So most people are doing 5-year terms. What that means is their interest rate is guaranteed for 5 years, and then after 5 years, they come back to their broker or bank. They try to renegotiate a better interest rate, at least better than what they're offering them at the time. And then you'd lock in for another 5 years, 3 years, what have you. For fixed rates, you can go all the way from 1, 2, 3, 4, 5, 7, and 10 years to lock in that rate. Variable, most lenders only offer 5 years, some 3. The amortization, which is where most people get confused between term, is how many years you have to pay off your mortgage. So if somebody says they have a 25-year amortization, that doesn't mean their interest rate is at 3% for 25 years. That just means it's going to take 25 years of payments to pay back your mortgage, and every 5 years, your interest rate is going to change. So with amortization, it actually increases or decreases your affordability as well. So when you have 20% down payment or more, if you increased your amortization to 30 years, you have 5 more years to pay off your mortgage, which means your monthly payments are going to be less, which means your mortgage affordability is going to be higher. And that's one of the true benefits of having a 20% down payment or more. Less than 20%, an insured mortgage, you can only have 25 years. That's the longest. And then also, if you wanted, there's prepayments that you can make throughout your term to keep it on a shorter schedule. So if you found out that if your monthly payments were $1,000 at your interest rate for 5 years over 25 years, but you wanted to pay it back on a 20-year schedule, and say that meant increasing your payments to $1,300, these are just random numbers here, that's not the actual difference between it, but that extra $300 a month is going to decrease how many years you have to pay your mortgage, which reduces the interests and the time overall.
So then, just kind of recap each situation and how each one affects people. So if the interest rate goes up, it means their mortgage payment is going to be higher, correct?
Correct.
If it goes down, then obviously the opposite. Now the term, does the term necessarily affect how much they're going to be paying?
Yes and no, because the term can have a different rate. Just because you're 3% on 5 years doesn't mean you're going to be 3% on a 3-year fixed term.
Right.
Lenders are going to have more attractive rates for a shorter term. Sometimes 4 years might be more equivalent to the 5, but you're going to have different interest rates for fixed terms depending on how long you lock it in for.
Okay. And then for the amortization, obviously because this relates to how fast they pay off their mortgage, if you lower the amortization period, say from 25 to 20 years, you're going to pay a higher mortgage payment.
Correct, but that increase in what you're paying is going to go directly towards principal. It doesn't mean you're paying more interest. The one thing that people have said to me is, can I get a 20-year amortization? You can, but if your affordability is being maxed out at 25 years, you cannot take a 20-year because now your monthly payments on paper are higher. But you can still make prepayments to keep you on a shorter schedule if you wish.
Gotcha. Okay, well I think that really sums everything up for me. We're going to be following this up with part 2 of this video where Ryan's going to break down fixed versus variable and actually give you examples between the two. So definitely stay tuned for that. Thanks guys.